Good morning and welcome to the Killik podcast for Friday, the 11th of December. The key question on our minds is, up till now, the trend has absolutely been your friend. And again, that was the case this week. But going into the interest rate rise next week, the question is whether it's better to travel and arrive. So looking at what's happened this week, we continue to see a falling oil price because of the shambolic OPEC meeting on Friday. Commodity prices continue to fall in anticipation of a rate rise in the US next week, and also corporate action like Anglo-American cutting their dividend and retrenching their business. We've also seen difficulty in the emerging market FX with specifically the People's Bank of China allowing their RMB rate to drift against the dollar, but we've also seen some political moves in South Africa with the replacement of their respected technocrat finance minister by a relative unknown. So more of the same, and we've been like a broken record talking about this for many weeks. So the question is whether the rate rise on Wednesday, as everyone is expecting, whether if it comes through, that'll mark a turning point in markets and sort of sector and value versus growth performance. So typically, the market response to a US rate rise is for the dollar to actually sell off because people have anticipated, and it's a better to travel than arrive event. And at the same time, because people are anticipating further higher interest rates, value stocks start to outperform growth stocks. So the relative positioning of value against growth, of US dollar against emerging market currencies is very extreme at the moment because, as you can see here this is the market capitalization of the UK mining sector. It's gone from around 300 billion all the way down to $500 million, so 85% fall. So clearly, it's been very difficult to be in that position during that movement. Equally, if you look at the interest rate differential between the US and the emerging markets, the carry trade could potentially come back into fashion in quite a big way if you see that FX rate start to stabilize. So you could be borrowing in US dollars and reinvesting in currencies like the Brazilian real or the ruble and getting a significant uplift in the interest that you're earning on your money. So next week, key results that we're looking at are Imagination Technology, Dixons Carphone and Accenture on Thursday. With Imagination Technology, clearly the market is very cautious going into their results, and that's post a downgrade from their house broker JP Morgan. So they're citing that royalty rates will be tougher in terms of the growth next year because their comps with Apple are more difficult because of the iPhone 6 launch last year. There's an inventory rundown going on in emerging markets, particularly China, and some legacy chips that were being run in Intel products are being withdrawn for the market sooner than anticipated and ahead of new customer win ramp-ups. So there is definitely elements of caution going into those numbers in terms of trading momentum. We continue to feel that there's value in the stock. The market cap is now 500 million. That's significantly below the investment that the company has made from cash flow into their technology. We continue to feel that this business has extremely strong strategic relevance in an industry that is moving towards mobile connectivity and security. And we're starting to see more a different type of breed of shareholder appearing on the register who are recognizing that. So we'll see what happens in those figures. Dixons Carphone has been strong into their numbers. It's worth just having a quick look at the rationale for holding this stock. So the backdrop is strong in the UK, strong consumer, good wage inflation coming through, limited competition for service-led sales of hardware on the high street, which is a strong positive for Dixons Carphone. Product cycle is looking more interesting at this point, so we're going into this Internet of Things rollout, and clearly they're well placed with connectivity with Carphone Warehouse and the hardware side with Dixons. They've got a very interested connected world services business, selling network and customer management to corporate, so B2B business that's not really reflected in the numbers at the moment. And then in terms of the near term, they've got significant synergies coming through from the merger between Dixons and Carphone, because they're merging those stores. They've got a very high cost of goods sold number that they can take some efficiencies out of. So we're very interested in that story. Finally, we've got Accenture. We've been banging the drum on this one for a while now. It's a company in transition. They're moving from consulting and outsourcing to digital operations and technology. In the numbers next week, we'll be looking at the growth rate that's coming through in digital. It's now 24% of revenues, growing at 35%. We'll be looking at the ongoing M&A in digital, cloud and security accelerating. So they're targeting around $1 billion of acquisitions in this space in 2016. Clearly, FX headwinds have been an issue for the stock. Hopefully they have normalized to a certain extent, and we'll look for confirmation of that return of $4 billion to shareholders through buybacks and dividends. So we think the outlook and the guidance for Accenture is pretty conservative, so we'll get a better feel for that next week on Thursday. So thanks for listening. Have a good weekend.